We are diving deep today into a really compelling corner of the market, high-yield ETFs, but specifically those in the crypto and fintech space.
Yeah, a very volatile space.
Extremely. And we're putting two funds under the microscope today. The Harvest Bitcoin Leaders Enhanced Income ETF, we'll just call it HBTE, and its counterpart, the Harvest MicroStrategy Enhanced High Income Shares ETF, or MSTE.
And both of these are built for income. I mean, they're targeting investors who want those big monthly distributions. But here's the thing. MSTE has been getting all the headlines, especially up in Canada this year, because of this just eye-watering yield.
Right.
But the team's analysis we've been looking at, it shows a really clear picture. HBTE, the one with the lower yield, is actually the strategically better long-term hold.
And that's really the mission for this deep dive for you listening. We have to look past that incredible, immediate income appeal. We need to understand why a fund that's promising, say, an 80 or 90% yield is often a massive red flag, a sign of trouble.
Right.
While another fund with a 25% yield, which is still huge by any standard, might actually be the definition of a durable investment in this sector.
It's all about structural risk versus diversification and, capital preservation. That's what really dictates true long-term income.
It's just so important because that headline yield, it can be such a distraction.
It really can. You have to look at the architecture of the ETF itself to see if it's, viable for the long run, especially with something as prone to wild swings as digital assets.
Okay, so let's start with MSTE, the fund that has everyone talking. It was so popular in 2025 because of that promise, high income. It sounds like the dream, right?
It sounds like it, yeah. Until you actually look at the structure, MSTE it's concentrated to an extreme. It doesn't even track Bitcoin directly.
Oh, that's a key point.
It tracks the fortunes of one company, MicroStrategy. And MicroStrategy is itself a highly leveraged proxy for Bitcoin.
Okay, let's really unpack that. The concentration. You mentioned the team sees this as a huge systemic risk, dependent on, and I'm quoting here, one person, one strategy, and one underlying stock.
Exactly.
MicroStrategy is famous for its aggressive Bitcoin buying, often with debt. So how does that leverage affect someone holding the ETF?
That's the fundamental flaw right there. MicroStrategy doesn't just hold Bitcoin, it has a mountain of debt to pay for it.
Yeah.
So if Bitcoin's price drops, that leverage it magnifies MicroStrategy's losses, way beyond the actual price drop of BTC itself.
And MSTE is basically just, writing options against that single stock.
Precisely. It's selling covered calls against that one single highly leveraged stock.
Yeah.
So the ETF inherits all of that magnified risk, all that volatility, with absolutely no buffer. If the stock gets hammered, the fund gets devastated.
And we should probably clarify how these funds even get that enhanced income. It's not like they're just paying out corporate profits as dividends.
Not at all. This is a vital technical point. Both HBTE and MSTE use derivatives, specifically covered calls.
Right.
They're selling the right for someone else to buy their assets at a higher price later. And in exchange, they get a cash premium right now. That generates the high monthly income.
But there's a big trade-off.
A massive trade-off. You cap your upside, and you expose yourself to huge capital loss if the underlying asset tanks, because you've been paying out that distribution even as the value of your fund is collapsing.
Which brings us right back to MSTE's crazy yield, 80 to 90%. That number just seems impossible. It should be an immediate red flag for any investor.
Absolutely. The team calls this a classic yield trap. That massive percentage isn't a sign of success. It's a symptom of acute distress.
So the payout hasn't actually gone up?
Not at all. The distribution hasn't improved. What happened is the price of the ETF itself has completely fallen off a cliff. So you might still be getting, say, 43 cents per share. But if that share now costs $5 instead of $11...
the yield percentage just skyrockets artificially.
Exactly. And a big chunk of what you think is income is really just your own money being handed back to you. It's a return of capital that's eating away at your principal investment.
That is the textbook definition of a yield trap.
It is. And given how volatile MicroStrategy is with its debt structure, the team said it's not inconceivable that the distribution will decrease.
Yeah.
So you're buying this highly concentrated, leveraged asset that is actively destroying its own capital base just to keep up appearances.
I understand the theory, but if MSTE is so brittle, how does HBTE avoid the same fate? I mean, how does the Harvest Bitcoin Leaders ETF actually diversify in a sector that's so tied to Bitcoin's price?
It's all about the underlying assets. The collateral pool is completely different. MSTE is one big bet on MicroStrategy. HBTE, on the other hand, casts a much, much wider net across the whole digital asset world.
So it's not just crypto.
No, it has blockchain tech, fintech, but it also goes into adjacent sectors, things like crypto miners, AI applications, data infrastructure.
So it's investing in the infrastructure behind the whole Bitcoin revolution. That feels like a much smarter, more resilient way to play it.
It is. And if you look at the holdings data from this December, it tells the whole story. HBTE does hold MicroStrategy, which is interesting.
Oh, it does?
It does, but it's only weighted at about 11%. It's part of the strategy, not the whole strategy.
That right there is the buffer. If MicroStrategy crashes, the damage is contained. So what are some of the other holdings that give it that breadth?
You see names like Robinhood, from the fintech trading space, and a company called Iron, which is a big player in crypto mining and data centers.
Okay, so they're definitely still in the crypto orbit.
For sure, but their business models are different. Robinhood depends on trading volume. Iron depends on energy costs and building out infrastructure. It's not the same as just being tied to a leveraged balance sheet like MicroStrategy.
And the team also noted that even with these stocks being down from their peaks, that dip plus the options income actually creates a buying opportunity now.
Exactly. When your underlying assets are cheaper, but the fund structure is still sound and the distribution is durable, that's a much healthier signal than a fake yield from a collapsing fund.
Okay, so let's put the yield side by side again. HBTE is at 25%, still very high. But the team calls it more realistic and durable. Why?
It's more durable because it's backed by a consistent 43-cent per share distribution that is held steady. The math is cleaner. It reflects a sustainable strategy across a diverse pool of assets, not an equation that just looks good because the fund's share price has collapsed.
Yeah.
You're getting income without, that massive capital impairment.
And here's where it gets really interesting, because we actually have the data to test this whole diversification idea. Let's look at what happened during that really volatile period in late 2025, from early November to early December.
This is the moment diversification really proves its worth. During that one-month period, a very stressed time in the market, MSTE, the concentrated fund, lost a staggering 38% of its price.
38%. In a month. Just think about the kind of recovery you'd need just to get back to even after a hit like that.
It's a massive hole to dig out of. I mean, even with a distribution, you're so far behind.
Right.
Now, in that same environment, HBTE lost 26%.
Okay. Still a loss, but that's a 12 percentage point difference. That's huge.
It's huge in terms of capital preservation. That 12% is the real, tangible cost of taking on that concentration risk. The other 15 holdings in HBTE, the fintech, the AI, the miners, they acted as shock absorbers. They smoothed out that extreme downside.
And if you zoom out and look at the whole fourth quarter, it's even worse for MSTE.
Well, much starker. MSTE dropped about 45% from its high in late October, which was around $11, all the way down to $5.75 by early December. That fast, severe drop is what created that fake, inflated 80+% yield.
And what was HBTE doing around that time?
It was much more stable, hovering around 1830, 1845, pretty close to its net asset value.
And that's an important point, the price being close to the NAV. It suggests the market still has confidence in the fund's structure.
Exactly. Whereas MSTE's price collapse showed, extreme pessimism about its ability to hold its value, regardless of what the headline NAV said.
So this really brings up a critical question for you, the investor. When you're looking at these high-yield products, do you go for the astronomical distribution rate, knowing that it might be just eating your own capital?
Or do you prioritize the fund's actual ability to survive a market shock and protect your principal from that kind of extreme drawdown? In these high-risk sectors, surviving the down cycle without getting wiped out is probably the single most important factor for long-term success.
So to bring this all together, the team's opinion is pretty definitive. Despite how attractive MSTE looks on the surface with that yield, HBTE is just the far better long-term investment.
Yeah.
That exposure to the whole Bitcoin ecosystem, the AI, the data infrastructure, it just offers much better risk management.
And we have to reemphasize that yield point. Because HBTE's 25% yield is sustained by a durable distribution, the team actually sees it as a better buying opportunity now with prices lower than back in October. You're buying durable income, not just a percentage distortion on a falling asset.
And this analysis isn't just a guess. It's based on, real research, financial economics, and years of investment experience. It's a conviction call.
And they're backing it up with action. The team just put out their 2026 investment plan, and they've actually included HBTE. It's got about a 5% weight in their plan, so they're putting their money where their mouth is.
So what does this all mean for your portfolio? I mean, the takeaway seems to be that real durability, especially in these high-income, volatile sectors, it requires breadth. It requires a strategy. That
Right.
massive leverage bet on one stock might look amazing for a while until the market turns. And when it does, diversification proves its worth by protecting you from those portfolio shredding losses.
And if we connect this to the bigger picture, the psychology of investing for income, it leaves us with a final provocative thought.
Go on.
If diversification protects your capital, and we know that these crazy high yields often signal capital erosion, that yield trap we talked about, then how much risk are you really willing to take on every month? At what point does that initial high distribution become completely irrelevant because your principal, your initial investment, has been so badly damaged?
It forces you to rethink what income investing even means. It's not just about the percentage payout.
It's about the security of the underlying asset base first. The payout is secondary.
A really important distinction. Now remember, this deep dive is for informational and educational purposes only. We always encourage you to do your own research and speak with a qualified advisor before making any investment decisions. Thank you for joining us for the deep dive.